The balance sheet. The balance sheet is a common and critical financial report that is used by a business to assess the current financial position of the business on any given trading day. In simple terms, the balance sheet provides an asset value of the business as well as a liability value of the business. The balance sheet is then used to subtract the liability value from the asset value to obtain the gross value of the business. This is referred to as the owner's equity. Let's start by looking at the first part of the balance sheet, which establishes the asset value of the business. Note in the current example that the listed assets of this hypothetical business are categorized into current and non-current assets. Current assets are defined as any asset that can be made liquid within an approximate period of 12 months. To make an asset liquid, you are simply realizing and acquiring its full cash value. You will also note that the assets are listed from the most liquid to the least liquid in descending order. Let's now look at current assets. You will notice with current assets that cash is listed first. Cash on a balance sheet refers to funds that are immediately available to the business without restriction, such as bank balance, money in the point of sale system, and petty cash. The cash value on this example balance sheet is $1,250. Next is trade debtors, which are the amounts owed to a business by its customers as a result of credit sales. Trade debtors are considered as one step away from cash and are most influenced by customer payment habits and the business's credit policy. The trade debtor value on this example balance sheet is $93,750. Next is stock. Stock is considered to be the goods in the process of manufacture as well as goods available and ready to be sold. Stock is considered to be 2 steps away from cash, as a customer has to decide to purchase the offering and then secondly finalize payment for the offering. The stock value on this example balance sheet is $100,000. Finally, on current assets we have prepaid expenses. A prepaid expense is any expense that has been paid for in advance. Common examples in business include insurance policies and domain names. The prepaid expense value on this sample balance sheet is $5,000. When we add the current assets together, we get a total current asset value of $200,000. Next, we have non-current assets, or assets in which the cash value is realized over a period greater than 12 months. The same principle applies for referencing the most liquid non-current asset on top, before moving on to the less liquid non-current assets in descending order. In this sample balance sheet, plant and equipment, which includes both fixed and non-fixed plant and equipment, are referenced as having a non-current asset value of $100,000. Next on the balance sheet is accumulated depreciation. This is the drop in value of the plant and equipment over time. A general rule in business is that plant and equipment depreciates consistently and annually until it reaches a cash value of 0. The period of depreciation typically ranges between 3 and 7 years. You'll note in the balance sheet the figure of $20,000 as the business's accumulated depreciation. You'll note that this figure is in brackets, which means it is a negative figure and needs to be subtracted from the total non-current asset value. In simple terms, the balance sheet is stating the asset value of the plant and equipment to be $80,000, as it was purchased for $100,000, but has depreciated or dropped in value a total of $20,000. Finally, in non-current assets, we have an asset value for both buildings and land. Please note that this will only occur in a balance sheet if the business legally owns the buildings and land. When we add the non-current assets together, we get a total non-current asset value of $300,000. And when this amount is added to the current asset value of $200,000, we can arrive at the total asset value of the business, which is $500,000. In some instances, you may find a third category of assets on the balance sheet, which is usually found below the non-current assets. This category is for intangible assets. An intangible asset is any identifiable non-monetary asset without physical substance. Intangible assets are typically patents and registered trademarks. A patent is a right granted for any device, substance, method, or process which is new, inventive, and useful. A patent is legally enforceable and gives the owner the exclusive right to commercially exploit the invention for the life of the patent. A trademark can be a word, phrase, letter, number, sound, smell, shape, logo, picture, aspect of packaging, or any combination of these. It is used to distinguish the goods and services of one trader from those of another. The next section of the balance sheet relates to liabilities and follows the same format as the asset section, with current liabilities relating to accounts that need to be settled within a 12-month period, and non-current liabilities relating to accounts that are settled over a longer time period greater than 12 months, such as loans. The most pressing accounts are listed first on the balance sheet, to the least pressing in descending order. As can be seen in this example balance sheet, the first current liability is listed as overdraft. Overdraft is a line of credit offered by a financial institution in excess of the business's account balance and typically needs to be repaid in a short period. In the example balance sheet, there is no amount of overdraft that needs to be serviced. Next on the current liabilities are trade creditors, which are outstanding accounts relating to suppliers or vendors. In the example balance sheet, the trade creditors amount is $55,000. Following this item is provision for income taxes or provision for taxes. This amount is typically calculated by an accountant and relates to likely tax liability incurred by a business that will fall due during the next reporting period. In this example balance sheet, the provision for taxes is $36,000. Finally, on the current liabilities section, there is an accrued expense account, which is for obligations that a business has incurred but not formally reported, such as sponsorship or charitable donations. In the example balance sheet, the accrued expense amount is $9,000. As can be seen in the balance sheet, when all current liabilities are added together, the total current liability value can be calculated. The total current liability value is $100,000. In the non-current liabilities section, or accounts that are settled over a period greater than 12 months, there are accounts relating to loan repayments. A loan may have been entered into by the business to purchase the business or purchase startup infrastructure such as property. In the example balance sheet, the non-current liability of the loan term has a value of $100,000. When we add the total current and non-current liabilities of the business together, we come to a figure of $200,000, which is the total liability value of the business. The final component of the balance sheet is the owner's equity. In simple terms, the owner's equity is the net value of the business determined by subtracting the liability value from the asset value. In the example balance sheet, the total asset value of the business was $500,000, and the total liability value of the business was $200,000. This simply means that the owner's equity is $300,000. The owner's equity can typically be divided into contributed capital, or finance injected into the business, and retained earnings, which are earnings achieved by the business in reporting periods that have been retained by the business and not distributed. the total owner's equity value in this hypothetical balance sheet is $300,000.